If you're thinking of buying a home, you've probably noticed that mortgage rates haven't budged much, and banks aren't exactly rushing to lend either. Philippine banks have actually cut their property exposure to a 6-year low, just 19.41% of total loans as of March, even with 3 trillion pesos in real estate credit still in the books. The Bangko Sentral also reports an uptick in non-performing loans, now at 111 billion pesos, with the biggest strain coming from mid and low-cost housing. So is this just prudent risk management or a warning sign that credit conditions are tightening even as monetary policy eases? And zooming out, the PSEi index is still in the red this year, down by about 2%. Investors aren't buying the recovery story despite rate cuts and a tame inflation outlook. To break it all down, we're joined by Gelo, Taningco, Chief Economist and Head of Research at Security Bank. Gelo, good to have you back.
Thank you for having me, Mikey.
Okay, Gelo, let's start with the big picture. Despite the 125 basis points of rate cuts by the BSP, tame inflation, the PSEi index, according to MarketWatch, is still down by 1.61% year to date. Why aren't our markets responding?
Well, there are other multiple factors affecting the stock market, particularly on the investor sentiment. And those headwinds coming from external sources, such as the tariff escalation by the U.S. in early April.
The global uncertainty.
Alongside the recent geopolitical risk in the Middle East brought about by the conflict between Israel and Iran, as well as the pushback on Fed rate cuts since they cut rates last year, were among those factors that contributed to the dampening of market sentiment.
Yeah, taking a look at where we're headed, how the first half was and where we are now and where we're headed as we are in this second half of the year, might reform, stable inflation and a dovish stance by the Bangko Sentral be enough to help spur momentum?
Indeed, we are upbeat on the second half, particularly on the local capital markets. We're looking at some upside on the Philippine Stock Exchange Index by year-end. Our target is at 6,800. Also, we're seeing lower interest rates in the bond market, primarily because of the upcoming rate cuts that will be initiated, not just by our local central bank, but more so also by the U.S. central bank.
Yeah, another thing that is, coming ahead is the overhang on the July 9 trade deadline. What's at stake for the Philippines as we approach Trump's July 9 deadline, that tariff deadline? What's at stake for us?
Well, ideally, there would be a trade deal forged between Philippines and the U.S. that will temper the tariffs. Currently, the Philippines is facing 10%, a 10% baseline tariff. Worst case is we go back to the reciprocal tariff proposed by the U.S. of 17%.
17%. That's the worst case scenario.
Worst case scenario, and that will, of course, hurt those sectors that are exporting heavily into the United States.
Okay, your targets. You said 6,800 for the PSEi index. Does that take this into account? It takes into account what kind of a tariff rate for the Philippines?
Yes. Because,
which one?
Because
that's at 17% already?
Right, because the impact of the tariff on the Philippines, even if it's 17%, is modest on the economy because we're more domestic oriented.
Okay.
And also, relatively, that 17% is much lower compared to the proposed reciprocal tariffs coming from our peers.
Yeah.
I think amongst the highest would include Vietnam.
Yeah.
And therefore, relatively, that can be an attractive proposition for the Philippines in terms of attracting
It's good to know that with that you've
investments.
taken the worst into account.
Yeah.
Speaking of other forecasts, the DBCC just downgraded the 2025 GDP forecast for the Philippines to 5.5%. From 5.5 to 6.5%, 6.5%, from 6.5 rather to 5.5%, in line with reality. What's your own projection at SecB?
We maintain our 5.9% full year 2025 GDP forecast. So that's already within the new target range of government.
At 5.9%, would you consider that a healthy trajectory?
Yes, it's close to the 6% growth trajectory. And despite the several and heavy headwinds, we think that's a healthy economic trajectory.
Hopefully they don't become too heavy. On the inflation front, Gelo, after 4 months of decline, the BSP says we could see a slight uptick in June, possibly accelerating to 1.9% from May's 1.3%. What's your outlook for June and for the full year inflation?
June inflation is 1.6%, and for the full year, we are looking at 1.9%. In both cases, that's below the central bank's target range.
Still very tame.
Yes.
Okay. Now, talking about the peso, do you expect the peso to depreciate in the second half of the year? This is when the trade deficit widens, typically in the third quarter, as we import more than we export seasonally. Apart from that, our possible rate cut by the BSP, expectations are for a 25 basis point rate cut from the BSP in the second half. What are your thoughts on the peso and on monetary policy?
Indeed, we are looking at a modest depreciation by the peso in the second half of the year because, as you mentioned, it's import season, balance of payment deficit to widen in the third quarter, and then some appreciation on the peso in the fourth quarter because of holiday-related inflows. Overall, the dollar is still inherently weak, so that's why we think that the dollar peso will move slightly upward, so our year-end target is still fixed at 57.
57 flat.
Yes.
Okay, now let's zoom in onto property. Banks' real estate exposure has dropped to 19.41% of total loans. This is the lowest level since 2019. Is this just smart risk management, or is this a sign of deeper stress?
Well, it's coming from a high base. During the pandemic period, 2021, 2022, it went up above 20%. But real estate loans are still growing. But the overall loan portfolio is growing more because there are other segments in the portfolio that are growing faster, such as consumer loans, particularly credit cards, also auto loans, and even those other productive activity loans, like in the power sector. You also have a bulk of the loans being channeled there.
Mm-hmm. Another thing to talk about when it comes to the property center, mortgage rates. They haven't budged by much. The BSP has cut interest rates by 125 basis points since August of 2024. But yet the average 5-year mortgage rate is still stuck at about 7.5%. Why isn't the easing cycle translating to better deals for borrowers?
Well, mortgage rates also fall, but it's not as deep compared to policy rates because one, you have the contractual obligation between the bank and the borrower. There are fixed rate loans, so that doesn't go down instantaneously.
Yeah.
Secondly, you also have to consider the funding cost of banks. So normally, in the Philippine scenario, the low-cost deposits tend to be dominant, and that's already having a low interest rate. So they're less sensitive.
So it won't go down overnight, and it won't be as wide as the rate cuts.
Yeah, so similarly, bank lending rates also do not follow fast in terms of the rate cuts because of the insensitivity of the funding costs of banks.
And obviously there's a lag effect.
Yes.
For it to trickle in, what's the timeline we're looking at?
Well, a couple of months, and that also depends on the situation, the economic condition, household demand for loans, and also the growth trajectory, among others. So, but a couple of months, maybe 3 to 6 months, or maybe a year, would be the lag effect of the bank lending channel into the real economy.
Okay, on another front, let's talk about non-performing loans to touch on the asset quality of the banking system. NPLs in mid to low-cost housing are now at 6.4%. How big of a warning sign is this, and how are banks adjusting their books behind the scenes?
Well, of course, the NPL ratio is a indicator of asset quality, but overall, I think that asset quality remains manageable in the banking system. There have been some, of course, upticks in the NPL space, but not as much. Say, I think for the overall UKB, the NPL ratio is still slightly above 3%, and that's not high compared to, say, historical situations. So in this sense, there is, of course, loans still growing by low teens overall. So that helps dampen the growth of the NPL in terms of the NPL ratio. Yeah.
Okay, and if you're advising a long-term home buyer right now, what's the one signal you'd tell them to track most closely? Is that still interest rates?
Yes, still interest rates, very important for home buyers and also investors in the property space.
Okay, and as we wrap up, Gelo, Chief Economist of Security Bank, what words would you like to leave the public, the business community, about the second half of the year?
We are still upbeat on the Philippine economy for the second half of the year because we still have a positive growth that's supported by monetary easing through rate cuts that will eventually channel into the lower bank lending rates and also loan demand to be spurred. Plus, you also have lower rates coming from inflation that's benign. And given those macro fundamentals, we think it's an overall positive story for the Philippine economy for the rest of the year.
Okay, thank you so much, Gelo Taningco, Chief Economist and Head of Research for Security Bank.
Thank you, Matthew.